Right now, Rezolve AI PLC, ticker RZLV, is trading at $3.15, down about $0.09 or 2.77% on the day, and the immediate gut reaction might be to see that red and move on. But that single-day move is hiding a much, much bigger story. Because while the stock is slipping today, what happened just yesterday is what everyone should be talking about. The company announced it has just poached a team of senior, high-level executives from Apple, Google, Microsoft, SAP, and Tata Digital. You read that right. This isn't a normal Tuesday press release for a company of this size. This is a statement. It's a declaration that they intend to fight the giants, and they're using the giants' own talent to do it. This single move is an attempt to instantly buy credibility, experience, and a network that would otherwise take a decade to build. It's an incredibly aggressive maneuver, and it creates a narrative so powerful it's almost blinding. The general belief, the expectation that is now baked into the analyst strong buy ratings, is that Rezolve AI is on the verge of a massive breakout. The story is just too good. Here you have a company that is perfectly positioned in the hottest sector, artificial intelligence, but with a specific, understandable focus: Agentic Commerce. They're not just another chatbot. They're building the infrastructure for AI to transact on your behalf. And as if on cue, Amazon CEO just recently started talking up this exact concept, validating the entire business model in front of the world. The company has fanned these flames by putting out an incredibly ambitious target of $500 million annual recurring revenue exit rate by the end of 2026. You add in the new dream team of executives, and the expectation is that this is the ground floor. It looks like the next NVIDIA stock before the big run, a story that's easy to believe. But this is where we have to separate the story from the numbers. The expectation is a rocket ship. The reality, when you get past the headlines and look at the actual filings, is far more complicated and far more sober. This stock is trading at $3.15 not just on a bad market day, but because the market is desperately trying to figure out what this company is actually worth. The hard reality is that this company is not profitable. It is burning through cash. The new executive team hasn't sold a single thing yet, and if you look at their last quarterly report, while they beat on the bottom line EPS, they missed on revenue. That's a critical detail. They are not yet meeting the growth targets that analysts have set for them. Furthermore, the consensus forecast from those same bullish analysts is that the company will continue to lose money through 2025 and 2026. This isn't a company with an earnings problem. It's a company that doesn't have earnings at all. It has a net loss. And perhaps most concerning for anyone holding the bag, shareholders have been massively diluted over the past year, with a 75% increase in total shares outstanding. That means your piece of the pie just got significantly smaller. The $500 million ARR target is a beautiful, ambitious goal. The current reality is a second quarter revenue of just $5.8 million. The gap between that expectation and this reality is enormous. This is why the stock's recent movement has been so chaotic. The 52-week range tells the whole story. It's been as low as $1.07 and as high as $8.45. This isn't investing, it's a battlefield between two completely different theses. The stock rips higher on news like the executive hires as narrative-driven traders pile in, then it bleeds out slowly as the financial reality sets in and long-term holders question the cash burn. The trading volume we saw on the back of that hiring news was immense, but today's volume is more subdued, more skeptical. It's the market digesting the sugar rush and wondering where the actual nutrition is. We can see from ownership filings that some big institutions are in. BlackRock, Vanguard, and State Street all have positions, but we need to be clear. For them, this is a tiny, speculative bet in a portfolio of thousands. It's a calculated flyer. It's not a core holding like their Apple stock position. This is a critical distinction for anyone doing self-investing and trying to mirror the smart side. You have to understand the context of their position, not just the fact that they have one. This level of volatility is brutal for a casual investor using the Robinhood app to check their balance. It's the kind of stock that requires a plan, a stomach for risk, and perhaps a more robust platform like Interactive Brokers to manage the complex order types needed to navigate this chop. So, what does Rezolve AI actually do to command this kind of attention? They are building what they call the brain for e-commerce. Their platform, powered by their BrainPoa large language model, isn't about helping you find a product. It's about being an autonomous agent that can understand a complex request, interact with multiple vendors, negotiate, and then complete the purchase, all without your direct involvement. Think, hey, I need to buy a last-minute birthday gift for my sister. She likes hiking and lives in Denver. My budget is $100, and the AI handles the rest. This is Agentic Commerce. And this is where the most common misunderstanding happens. The company has boasted of processing over $50 billion in gross merchandise value, or GMV. But that is not their revenue. That is the total value of other people's stuff that moves through their platform. Their revenue, the $5.8 million in Q2, is the tiny slice they take for providing the service. They are a B2B platform, a toll booth on the e-commerce highway, not the highway itself. Their success depends entirely on convincing major retailers like their current clients, KFC, Ace Hardware, and the Phoenix Suns, to integrate their technology deeply into their operations. This is much harder, slower sell than just building a popular app. Looking at their recent history, it's a blur of high-stakes financial engineering. They've completed their NASDAQ listing, they've raised capital, and they've strategically converted $59 million in debt over to equity. These are not the moves of a stable, mature company. These are the all-or-nothing moves of a startup in its final growth stage, using public markets to fund its ambitions. This is why comparing it to Tesla stock in its early chaotic days might be more appropriate than comparing it to a Fidelity or a Charles Schwab. This is a venture capital stage company that just happens to trade every day. It's a high-wire act with no safety net. This is why investment help is so crucial in a name like this. An intelligent portfolio or a robo-advisor from a place like SoFi would likely never touch this. It's a pure individual brokerage play for investors with a very specific, very high risk tolerance. They are poaching talent from the biggest names in tech. Comment below, do you think this new dream team from Apple and Google can actually deliver on a $500 million revenue target, or is this just expensive marketing? This brings us to the future outlook, and the tension could not be clearer. The expectation, the bull case, is built on a magnificent story. It's a story of a strong buy consensus from analysts with price targets at $9, $10, even $15. It's a story of a new all-star leadership team that has the blueprints from Apple and Microsoft. It's a story of foundational partnerships with Google and Microsoft and a market concept validated by Amazon itself. In this version of the future, the company scales their platform, signs hundreds of new enterprise clients, and that $5.8 million in quarterly revenue begins to compound exponentially, finally growing into that $500 million ARR target. In this future, $3.15 looks like an absolute steal. The reality, or the bear case, is built on the numbers. It's a case built on persistent cash burn, negative earnings per share, and a revenue stream that just missed expectations. It's a case built on the fact that an all-star team of executives costs a fortune in salaries and stock-based compensation, adding to the cash burn before they've generated a dollar in new sales. The reality is that the 75% dilution has already hurt existing shareholders, and more capital raises might be necessary, leading to even more dilution. The risk is that Agentic Commerce is a decade-long project, not a 24-month sprint, and that competitors like Amazon, Google, and Apple themselves will simply build their own better versions. In this future, the company fails to execute, the growth story breaks, and the stock drifts back to its $1.07 lows. So we are left with this stark contrast. A stock sitting at $3.15 down on the day, but a company that is the subject of one of the most explosive narratives on the market. The expectation is a world-changing AI platform that will redefine how we shop, led by a team of Silicon Valley titans. The reality is a deeply unprofitable, highly speculative, and massively dilutive small-cap company. The ultimate question for anyone looking at this on their Fidelity mobile app or considering it for their Fidelity Wealth Management portfolio is this: are you investing in the story or are you investing in the balance sheet? Because at this moment, they are telling two completely different tales.